Over the years, I've seen far too many founders absolutely blow their first shot at raising venture capital money. And the worst thing is, those failures could have been completely avoided. So, to prevent that from happening to you, in this video, I'm going to be showing you the top 10 most common mistakes people actually make when trying to do an institutional raise. And not only that, but how to avoid and fix those mistakes so it doesn't happen to you. So let's get right into it. First mistake, sloppy or messy cap tables. One of the first things institutions check is your cap table, believe it or not. And if it's filled with dozens of small friends and family investors, multiple safe notes, or handshake equity promises, it signals chaos, and they don't like that. When investors see that, they assume fixing it will take lawyers, money, and months of time, and most won't even bother. They'll just pass. The fix is to clean your cap table before you raise. So you want to consolidate, formalize, and simplify so it looks professional and easy to understand. Okay, mistake number 2, unrealistic valuation expectations. I see this every single day. Nothing kills momentum faster than asking for a sky-high valuation without backing it up. If comps in your space are trading at 6 to 8 times revenue and you're demanding 15, investors will assume you're either unrealistic or, even worse, uncoachable. So here's the fix. Use data to support your valuation. Simple, right? Show comparables, revenue multiples, and especially traction. A fair valuation gets you funded. An inflated valuation gets you passed over. Mistake number 3, not knowing your numbers inside out and cold. Investors expect you to know your numbers absolutely inside and out. That means CAC, churn, margins, burn rate, runway, without looking at notes. If you stumble on these, it tells them that you don't have control of your business. And that's an instant credibility killer. And here's the fix. And it's actually quite simple. Rehearse. Duh. Rehearse it until you could answer every core financial and market question instantly. Come across like a founder who thinks like a CFO. If it means practicing with your kids or your wife, do that. And mistake number 4, weak governance and no institutional infrastructure. So governance might feel boring to you, and I get that, but it's the absolute backbone of institutional funding. No board, no CFO level oversight, no audited financials. That's all screams not ready. Institutions, they won't risk millions on a company that doesn't look built for scale. So here's the fix. Put the basics in place early. Add a part-time CFO, appoint independent board members, and keep your financials audit ready. Mistake number 5, investor targeting mistakes. Another common mistake is pitching to the wrong funds. For example, chasing $1 billion firm when you're raising only 10 million, or pitching biotech VCs when you run a SaaS company. That's wasted time for you and bad impression with them. Remember, you don't get a second shot at this. You got to do it right the first time. So here's the fix. Build a precise investor list that we've talked about in several other videos. And this may seem commonplace to you, but you only want to focus on funds that invest in your sector, at your stage, and at your check size. I can't say this enough. So quick side note here, a lot of these mistakes tie back to not being investor ready. I would say of the 8 to 12 calls we get at our firm every single day with people looking to raise institutional capital saying, I need 20 million, I need 100 million, 70 to 80% of them are not ready for institutional capital. They're just not. So that's why I put together a free checklist called the Investor Readiness Scorecard. It walks you through 25 items that VCs look for before writing that check. And you could grab it for free. There's going to be a link somewhere below. Go ahead and grab that. It's free. You'll love it. You're welcome. It'll help you instantly know if you're ready for your raise or what gaps you need to fix first before going for that raise. Mistake number 6, unit economics that don't scale. Growth on its own doesn't impress investors. They don't care. So if acquiring customers costs you more than you'll ever make back from them, scaling just digs a deeper hole. Institutional investors, they always model this out. You're not going to trick them. So if your margins collapse as you grow, they will not invest. The good news is, here's the fix. Test and refine your economics before you raise. You got to adjust pricing, optimize acquisition, and reduce churn so that every new customer adds profit and not losses. Mistake number 7, overly complex deal structures. Founders sometimes think clever deal structures make them look sophisticated. In reality, complicated waterfalls, special share classes, or earnouts, they just scare off serious investors. Keep it simple, stupid, like mom always said. Complexity signals risk, and institutions hate risk they don't control. So here's the fix: you keep your terms clean and straightforward. Preferred equity and a simple structure gets deals done. Mistake number 8: poor storytelling and no why now. Again, this is another one out of the 8 to 12 calls a day of people that are looking for institutional capital. And we review their decks. Boy, I'll tell you, most people miss the storytelling. So even if your numbers are solid, a pitch without a story, it's going to fall flat. If you can't explain why this company, why now, why you're going to be forgettable. Institutions want urgency. They want to feel like there's a unique market window that only you can capture. So here's the fix: build a compelling narrative. Tie your story to market timing, tailwinds, and your unique credibility as the founder. Mistake number 9: ignoring the competitive landscape. Saying we don't have competition is one of the fastest ways to lose credibility. Don't ever do that. Every business competes with somebody else, even if it's the status quo. So when you ignore competitors, institutions assume you don't understand your own market. The fix: acknowledge your competition up front, get it out of the way, then explain your wedge. Show why you can win in a crowded field. And last but not least, probably the most important mistake, number 10: overpromising on projections. I mean, the single biggest mistake founders make is showing projections that no investor could believe, jumping from 0 to 100 million in 3 years without a real plan. When investors see that, they absolutely tune out immediately. So here's the fix: be ambitious, but realistic. Show the big vision, but back it up with believable milestones and assumptions. Because that combination of credibility and ambition is what closes institutional checks. And if you're doing your seed round, you'll want to check out this video right here, where I show you how to get ahead of 99% of all the people in your seed round, so you can stand out from all the competition, get funding, and build the business you've been dreaming of building. I'll see you over there.